Namaskar and welcome to our channel. Today we are going to discuss one of the most important topics for every finance professional working in India, Ind AS or Indian Accounting Standards. If you are working in accounts, finance, audit, taxation, banking, manufacturing or corporate finance, understanding Ind AS is extremely important. It is also a very important topic for CFO, finance manager, senior manager, CA, CMA and CMA and CS interviews. In this video, I will explain what is Ind AS, why was Ind AS introduced, difference between AS and Ind AS, applicability of Ind AS, important Ind AS standards, treatment of revenue, inventory, fixed asset and leases, financial instruments, deferred tax, consolidation, important ratios and disclosures, common mistakes, and finally some important interview question. So let's start. Ind AS stand for Indian Accounting Standards. These are accounting standards prescribed in India and are largely conversed with International Financial Reporting Standards or IFRS. The main objective of Ind AS is to ensure that financial statements provide a true, fair, transparent and comparable picture of the financial position and performance of an entity. Under traditional Indian accounting standards, there were several accounting practices that were different from international practices. With increasing globalization, Indian companies were raising money internationally, acquiring foreign companies, and dealing with international investors. Therefore, there was a need for financial statements to become more comparable globally. This resulted in the introduction of Ind AS. However, one important point is Ind AS is not exactly the same as IFRS. India has made certain modifications known as carve-outs and carve-ins to suit Indian legal and economic condition. So why was Ind AS introduced? Let's understand why Ind AS became necessary. First, global comparability. Suppose an Indian company and an European company operate in the same industry. If both companies follow internationally comparable accounting principles, investors can compare their financial performance more easily. Secondly, better transparency. Ind AS requires extensive disclosures. This helps investors, lenders, and other stakeholders understand the company's financial position. Third, fair value accounting. Ind AS places greater emphasis on fair value measurement in several areas. Fourthly, substance over form. Ind AS focuses on the economic substance of transaction rather than merely their legal form. For example, suppose an asset is legally owned by one party, but substantially all risks and rewards are transferred to another party. Ind AS may require accounting based on underlying economic substance. Fifth, better investor decision making. The ultimate objective is to provide useful financial information to shareholders, investors, lenders, and management. Now, who needs to follow Ind AS? Now, an important question. Which companies are required to follow Ind AS? Ind AS applicability is governed primarily through the relevant position of the Companies Act, provisions of the Companies Act 2013 and the Companies Indian Accounting Standard rules. Applicability depends on factors such as listing status, net worth, holding subsidiary or associate relationship, nature of the company, sector specific requirement. Ind AS has been implemented in phases. Lots listed and unlisted were brought under Ind AS first, followed by other specified entities. One very important point for finance professional is Ind AS applicability can also extend to subsidiaries, associates, and joint ventures of the Ind AS reporting parent subject to the applicable rules. Therefore, when determining applicability, don't look only at the standalone company. Always examine the entire corporate structure. Important Ind AS standards. Let us now discuss some of the most important Ind AS standards. There are many Ind AS standards, but for practical finance work, some are particularly important, such as Ind AS 1, presentation of financial statements. It deals with the presentation of financial statements. It covers balance sheet, statement of profit and loss, statement of changes in equity, cash flow statement, notes to accounts. It also deals with classification of asset and liabilities and presentation requirements. Secondly, Ind AS 2, inventories. This is extremely important for manufacturing companies. Inventories include raw materials, work in progress, finished goods, stores and spares, and other inventories. Inventories are generally measured at lower of cost and net realizable value. Cost can include purchase cost, conversion cost, other costs incurred to bring inventory to its present location and condition. For a manufacturing company, determining the more cost of WIP and finished goods is particularly important. Now, statement of cash flows. Ind AS 7. Cash flows are classified into operating activities, investing activities, financing activities. For example, cash received from customer is generally operating. Purchase of machinery is investing. Borrowing from a bank is financing. So these are the example. Now, let's discuss three very important standards. PPE, property, plant and equipment, intangibles and impairment. So Ind AS 16, property, plant and equipment. This deals with tangible fixed assets. Fixed assets. Example include land, building, plant and machinery, electrical equipment, vehicles, office equipment. Initially, PPE is generally recognized at cost. Cost can be include that purchase price, directly attributable cost, installation cost, site preparation, certain dismantling or restoration obligation. After initial recognition, an entity generally follows either cost model or revaluation model, depending upon the applicable accounting policy. Depreciation is charged systematically over the useful life of the asset. Ind AS 38, intangible asset. Now what we have discussed above is a tangible asset. Now it is intangible asset governed by Ind AS 38. Example include software, patents, copyrights, licenses, certain development cost. An intangible asset must satisfy the recognition criteria before it can be recognized. The useful life can be finite or indefinite. Finite life intangible assets are amortized over their useful lives. Ind AS 36, impairment of assets. This is also an important. The standard deals with the impairment. Suppose a company's machinery has carrying value of rupees 10 crore. Due to technological changes, the recoverable amount falls to 7 crore. Then there may be an impairment loss of 3 crores. Rupees 10 crore minus 7 crore. So 3 crore is the impairment loss. The basic principle is then asset should not be carried for above its recoverable amount. Okay. So now revenue and leases. AS 115, revenue from contracts with customers. This is one of the most important Ind AS standards. Ind AS 115 follows 5-step model. Identify the contract, determine whether a valid contract exists with the customer. Number 2, identify performance obligation, determine what goods or services have been promised. Number 3, determine transaction price, determine the amount consideration expected. Number 4, allocate the transaction price to different performance obligation. Number 5, recognize revenue. Revenue is recognized when or as the performance obligation is satisfied. For example, suppose a company sells machinery along with 2-year machine maintenance service. The machinery and maintenance service may represent separate performance obligation. Therefore, the total consideration may need to be allocated between them. So next, Ind AS 116. Ind AS 116 significantly changed the lease accounting for leases. Generally, a lease recognizes right of use asset and lease liability for leases within its scope subject to applicable exemption. For example, if a company takes an office building on a long-term lease, the accounting is not simply rent expenses is equal to cash paid. Instead, the company generally recognizes the right to use the asset and a corresponding lease liability. This result is depreciation on right of use asset, interest expense on lease liability. This is an important area of finance function. Then financial instruments. Now we come to one of the most important and technically challenging areas of Ind AS. Ind AS 109, financial instruments. Financial instruments include loans, debentures, trade receivables, investments, bank balances, derivatives, certain guarantees and other financial contracts. Ind AS 109 covers classification, measurement, impairment and has accounting. Expected credit loss. Expected credit loss ECL. One of the major changes under Ind AS is expected credit loss model. Under the older approach, impairment was often recognized after evidence of loss amassed. In Ind AS 109 follows a more forward-looking approach. For example, a company has a trade receivable of rupees 10 crore. Management estimates that based on historical experience and forward-looking information, 50 lakh may not be recovered. The company may need to recognize a loss allowance based on the applicable ECL model. This is particularly important for banks, NBFCs, large manufacturing companies, companies with significant trade receivables. Okay. Then comes the deferred tax. Now let's discuss Ind AS 12, income taxes. One of the most important concepts is temporary difference. A temporary difference arises when the carrying amount of an asset or liability is in the books differs from its tax base. This can result in deferred tax asset, that is DTA, or deferred tax liability DTL. For example, suppose the book value of an asset is 80 lakh, but its tax base is 60 lakh. Temporary difference is 20 lakhs. Depending on the nature of the difference, applicable tax rate, deferred tax may arise. An important point, deferred tax is based on temporary differences, not simply on permanent differences. The distinction is very important for finance function. Consolidation. Another very important area is consolidated financial statement. The key standard is Ind AS 110, consolidated financial statements. Suppose company A controls company B. Another very important area is consolidated financial statements. The key standard is Ind AS 110. Suppose company A controls company B. Company A may have to prepare consolidated financial statements presenting the group as a single economic entity. Other important standards include Ind AS 28, investment associate and joint venture, Ind AS 111, joint arrangements, Ind AS 112, disclosure of interest in other entities. The concept of control is extremely important. Control generally involve power over the investee, exposure or right to variable returns, ability to use power to affect returns. Other important Ind AS includes, let's quickly look at several other standards that finance professionals should know. Ind AS 10, events after reporting period. Ind AS 19 employee benefits. Ind AS 20 grants, government grants. Ind AS 21 effects of changes in foreign exchange rates. Ind AS 23 borrowing cost. 24 related party disclosure. Ind AS 33 earning per share. Ind AS 34 interim financial reporting. Ind AS 37 provisions, contingent liabilities and contingent assets. Ind AS 103 business combination. Ind AS 108 operating segments. Ind AS 109 financial instruments. Ind AS 110 consolidated financial statements. Ind AS 115 revenue from contracts with customers, already have discussed above. Ind AS 116 leases, we have also discussed. So you should understand the practical impact on financial statements of all these standards. Now let's finish with some very common Ind AS interview questions. Question number 1: what is the difference between AS and Ind AS? So answer should be Ind AS is largely conversed with IFRS and contains several concepts such as fair value measurement, control based consolidation, expected credit loss and right of use accounting that differ from traditional Indian GAAP in various areas. Okay, now question number 2: what is the difference between provision and contingent liability? A provision is recognized when the applicable recognition or criteria are met and there is a present obligation with probable outflow and reliable estimate. The contingent liability generally represents a possible obligation or a present obligation that does not meet the recognition criteria. So what is substance over form? It means accounting should reflect the economic substance of transaction rather than relying solely on its legal form. Next question: what is ECL? Expected credit loss. Expected credit loss, it is a forward looking impairment model used under Ind AS 109 for applicable financial assets. Question number 5: what is the basic principle of Ind AS 115? Revenue is recognized based on satisfaction of performance obligation under the 5-step revenue recognition model. Now, so Ind AS is not simply an accounting rule book. It changes the way companies measure assets, recognize revenue, account for leases, measure financial instrument, recognize impairment, calculate deferred tax, prepare consolidated accounts and disclose financial information. For financial professionals, understanding the business impact of Ind AS is much more important than simply memorizing the standard numbers. If you found this video useful, please like, share and subscribe to the channel and comment below which Ind AS should we explain in detail in our next video. We can cover topics such as Ind AS 115 revenue recognition, Ind AS 109 financial instruments, Ind AS 116 lease accounting, Ind AS 12 deferred tax and Ind AS 103 business combination. Thanks for watching. Keep learning, keep growing, keep improving your financial knowledge. See you in the next video.